Live from Pier 3 in San Francisco, welcome to Bloomberg West, where we cover the global technology and media companies that are reshaping our world. I'm Emily Chang. Our focus is on innovation, technology, and the future of business. Let's get straight to the rundown. Facebook gets its show on the road as Mark Zuckerberg, Sheryl Sandberg, and other Facebook execs meet with potential investors in New York. We have details of what happened behind closed doors. Third Point's Dan Loeb takes legal action against Yahoo, demanding to see all records related to the hiring of CEO Scott Thompson. Could the new chief Yahoo's botched bio be enough to force him out? And jurors find Google guilty of infringing Oracle's copyrights when it built Android, but deadlock on whether the infringement counts as fair use. We break down the verdict and what happens next. But first, to the lead. Facebook is officially on the road. Facebook CEO Mark Zuckerberg, COO Sheryl Sandberg, and CFO David Ebersman all gathered at the Sheraton in Manhattan to make a presentation to investors today. Zuckerberg arriving in his characteristic hoodie and jeans. The line of potential investors snaked through the lobby and around the building, contrary to some reports claiming Zuckerberg's decision to go to New York was last minute. Sources familiar with the situation tell Bloomberg West he always planned to be there in person for the first day of the roadshow, though he may not be able to attend at all. From New York, the roadshow will head to Boston and then back to Silicon Valley. Facebook is scheduled to price the offering next Thursday and start trading the following day. For more on the play-by-play, let's bring in our senior West Coast correspondent, John Ehrlichman, who is on assignment in L.A. John, what can you tell us about what happened inside?
Well, hoodies aside, Emily, there wasn't anything that was that unusual about this IPO roadshow, according to the people that we've spoken to. The most unusual thing was the level of security. It's why it took a long time for the investor meeting to get started. And also, if you needed to go to the bathroom during the presentation, you needed a guard to escort you out of the room. But as far as how things played out, the CFO, David Ebersman, took the stage for a few minutes at the start. They had a video presentation for 20 or 25 minutes, including some of the material, obviously, that people saw late last week when the IPO update was provided. And then it was, as you mentioned, Mark Zuckerberg, Sheryl Sandberg, and Ebersman, who took questions from the audience for about 35 minutes, upwards of 9 or 10 questions on a whole host of issues, from the company's growth prospects going forward to that recent purchase of Instagram, to the Zynga strategy, and of course the realities of the Chinese market. And the feedback we got was that basically, the executive team was direct on all of these issues, especially with a market like China, that it's an interesting market, but they're nowhere close to being in China, and it's not the kind of thing that investors should be baking into their financial models tied to Facebook.
What about growth? What did they have to say about growth slowing down over the last year, you know, when Facebook is supposed to be growing the fastest?
Yeah, I mean, I think they were realistic in the sense that they're not going to grow at the same rates that they grew in their first few years. I mean, when you go from 100% growth, it's tough to keep that up, especially when you've got the user base that they have now and people spend the amount of time that they spend every day on Facebook. They said it's more about just making sure that we make the user experience a positive one for everybody who's already on Facebook and a positive one for those advertisers who are obviously giving us a lot of money right now. But specifically on the mobile issue, obviously a lot of people have talked about the smartphone strategy for Facebook, and they said, look, we've got to step up our game here, and certainly when some other players like Google have shown a pretty good ability to make money off of mobile so far, Facebook might have some work to do in that category. And they were admitted to that very fact.
Now, speaking of mobile, you mentioned Instagram. Some have criticized Mark Zuckerberg for going rogue, essentially, on this deal without consulting the board. Did he have anything to say about that today?
You know, this is where Mark Zuckerberg got more passionate in this meeting. And the reality is, and he said it, this deal did come together quickly, but he said the partnership and basically the relationship between the two companies was not something that came together quickly, that they knew each other well, and he was really just waiting for his opportunity to do a deal like this. When that window opened up, he went ahead and did something, but certainly he suggested they're not going to do these kinds of deals going forward this size, but they are going to keep acquiring small companies to get the talent.
So, John, what's the overall takeaway now? Is Facebook going to be stealing Google investors?
You know, one of the biggest takeaways I got from speaking to an investor who was there today was that this is somebody who's very much thinking about investing in the IPO if it's priced at the right price. However, this is somebody whose takeaway today was that they might put some fresh money into Google as well, just because after you hear the whole presentation, you get an idea that perhaps the Google business model is not the same business model. So that was an interesting development, I thought, today as well. Emily?
Interesting, since they've been compared time and again. John Ehrlichman down in L.A., thanks so much. We are, of course, going to have much more on Facebook's road to an IPO coming up later on Bloomberg West. But first, another big story we are following today. Third Point's Dan Loeb now taking legal action against Yahoo. The activist investor is demanding to see all documents related to the hiring of Yahoo CEO Scott Thompson. This after the company admitted Thompson does not have a computer science degree from Stonehill College, yet Yahoo's latest SEC filings said that he did. Our Bloomberg West editor-at-large, Corey Johnson, is here with more on the fallout for this story. Everybody is talking.
Yeah, people talk about it. I was talking to people about it all weekend.
Exactly.
And I don't have a computer science degree from Stonehill College either. I have nothing from Stonehill College.
Good to know.
Not even a sweatshirt.
Good to know. I'm glad we clarified that.
People were not too worried about that. But, you know, this is a really big issue, and it's really interesting. And as the document trail starts to unfold, you can see what happened here, which is that in his prior job at eBay, in his prior work as a director at F5 Networks, even in the recently filed Splunk IPO, in which Scott Thompson's a director, they all refer to his accounting degree at Stonehill College, not accounting and computer science. But
so this predates Yahoo, essentially, this error.
Well, no, so the error didn't seem to. Because in the SEC filings, no one had ever claimed they had a computer science degree. But if you look at the old website that eBay used to have up, which you can find in this great website called the Wayback Machine, the old one said he received a bachelor's degree in accounting and computer science. So this was on the eBay website up until Scott Thompson suddenly quit to join Yahoo. So this lie goes back at least a year, perhaps longer, on Yahoo's website. Now, Dan Loeb alluded to this in his filing today. Well, it wasn't actually a lawsuit, but it is what's called a demand. And in corporate law, for shareholder law, it can predict a lawsuit 90 days later. And they're very specific about requesting lots of documents. They want to know what the board knew, when they knew it, what Scott Thompson, how he represented himself, to try to find the origins of this lie.
And they also want Scott Thompson fired. Yeah,
they wanted to fire. They wanted fired right away. And I got to tell you, a lot of people I've talked to have said the same thing, that this is wrong, that people have been fired for this kind of thing in the past. And furthermore, Yahoo is not a company where he's got a long history of running the thing and this discovery was made along the way. Rather, he came in here with this credential on his resume that wasn't actually his credential. As Dan Loeb points out so eloquently in his shareholder letter last Friday, saying, how can Scott Thompson command armies of engineers at Yahoo, some of whom actually earned a degree in computer science, when he just claimed to have earned one and just added the name?
Speaking of that, what has Scott Thompson actually said about this so far?
The company came out initially saying the error was inadvertent, which we talked about on the air, which just can't be true, right? It was very purposeful. It was put there with an intent. And where did it come from is the question. Now, Scott Thompson hasn't commented on this directly. Dan Loeb posits in his letter the board didn't know about the response, that the response of the inadvertent credential was from Scott Thompson himself. But there was an interesting interview posted online. Kara Swisher of All Things D found this thing. Moira Gunn, who runs this great radio show called Tech Nation, interviewed Scott Thompson a while back, and he seemed to refer to himself as an engineer, which he's not.
And also in that interview, I believe the interviewer mentioned that he had a degree in accounting and a degree in computer science. And it appeared that Scott Thompson did not deny.
Yeah, indeed. Seemed to suggest he had great benefit from having both these degrees, but didn't actually correct the interviewer in this case.
Well,
so this has been going on for some time.
We will see which turn this story takes tomorrow. It's definitely a talker. Thanks for that, Corey Johnson. Up next, a jury has found Google guilty of copyright infringement, but deadlocks on whether Google's use of Java to build Android was fair use. We break down the partial verdict next. And the Avengers gives a new meaning to the word blockbuster, bringing in a record-shattering $207 million in its North American debut weekend. How Disney's big bet on Marvel paid off big time. Coming up. is Bloomberg West. I'm Emily Chang. Oracle wins the first round of its showdown with Google. A jury reaches a partial verdict finding Google guilty of infringing Oracle's Java tools. But the jury couldn't decide whether Google's use of Java counted as fair use. The verdict came down after the judge questioned a juror who allegedly spoke with her husband about the case. That juror insisted the discussion did not influence her decision. For the latest, we are joined again by our editor-at-large, Corey Johnson. So, Corey, was this the big win Oracle was looking for?
Well, you'd think so. They got so many wins and so many counts, but as you mentioned, maybe the most important count, the fair use count, they didn't get. And the reason that's so important is because this was an odd case of copyright infringement when it was also about patent infringement, and the jury at the end of the day couldn't decide if Oracle had already granted a fair use. Now look at what the stocks did. We always say in the drill down we're going to look at the company news behind the stock on the move. If you look at the one-day chart of Oracle, and you can see what happened to the stock when it looked like when people started to figure out this decision wasn't great for them. Similarly, look at Google, had the opposite reaction when people figured out it wasn't as bad for them as it might have suggested. But there's a lot more to come in this case.
So, Corey, is this typical of a patent infringement case where the findings are a little bit confusing?
Well, here's what's weird about it, is the two aspects of this case, the copyright aspect and the patent aspects. Because what Oracle has, I'm starting to say Goracle with just such familiarity, but what Oracle has said that Google did was not only use their patents unfairly and illegally and without permission, without licensing, but they also used the descriptions on how to use those patents, known as the APIs. They said that the APIs themselves were copyrighted and that, in fact, Google had used them without permission. So the jury came back and said, yes, they did use all of those instruction sets, and those were copyrighted, but we're not sure if that use was fair or not. We can't decide on that one. So the patent portion of this trial, I kind of expected that once they decided the first part, we have a real good indication as to where the jury was leaning, but we still don't, because we still don't know what they're going to think, whether these patents were infringed or whether, in fact, Google had permission because of the fair use and open standards that these patents may have been held under.
And phase 2 about patents has already begun. Corey Johnson, our editor-at-large, thanks so much. Now, what is the next step, and what does this partial verdict mean for both of the tech giants? Here to answer that question is Pat Walravens, Managing Director and Senior Analyst at JMP Security, who covers Oracle. And even you say this is a little confusing, this verdict. Why?
Yeah, this one was a head-scratcher. Well, so the jury had to answer 3 questions today. They had to answer, did Google infringe the API? And they said yes. And did Google infringe the documentation, so the plain English language that goes around the API? And they said no. And was Google's use a fair use? And the jury could make up their mind. So you're left a little bit in Never Never Land. Right.
So there are some unanswered questions.
Yep.
And the fair use thing is quite an important point, right?
Oh, yeah. It makes all the difference in the world. Because, you know, under copyright law, there are some uses which are viewed as being in the public interest, which are okay. And so if you leave that out there, you really haven't decided.
So Oracle thanked the jury in their statement today, but how big a win is this really for Oracle?
We don't know yet. So the other guy who hasn't finished his job yet for phase 1 is the judge. The judge still has to rule on whether APIs can be copyrighted at all. And if he rules yes, then I would say Oracle got a half a victory. If he rules no, then, you know, the copyright case is pretty much shot.
Now, the next phase is the patent phase. After that, there's the damages phase.
Yeah.
How do you expect this to play out? You know, what's sort of the worst-case scenario?
Well, for Oracle, there's not that much downside, right? The worst-case scenario is they spend a lot of money on legal fees and they end up with nothing.
Right.
Google, has more risk here, because for Google, the worst-case scenario is that they end up having to pay a royalty to Oracle on all of those searches that happen on a mobile device.
What do you expect?
Oh, it's so hard. It's really difficult. I think this is a tough one for Oracle.
Now, what else is in it for Oracle? I mean, you yourself have said the Sun acquisition isn't going so well. This sort of helps them improve the results of that?
Yeah, so there are 2 things, I think, if you're Oracle. One is you spent $6 billion on Sun, right? And the hardware part of that business has proven to be pretty challenging. You also acquired some software assets like Java. So if you can monetize Java, great. That makes the Sun acquisition seem like it was a better investment. The second thing is there's some big trends in our industry, right? What are the big trends? Facebook, obviously. So there's social, there's mobile, there's the cloud. And Oracle's late to the cloud, right? Social, they're really not playing in it. So if they can get a piece of mobile, that would be helpful for the story.
And you are also an attorney. What are you going to be looking for in the patent phase of the trial? What should we be watching out for?
You know, I think that the key thing is just that the jurors seem to understand better than, so when you sit in the courtroom, everyone was so confused. The lawyers were tripping over themselves, the judge was scratching his head.
I mean, if you're confused, then you can imagine the jury's a little bit confused.
Oh, it was nuts. At one point, one of the expert witnesses pulled down a whiteboard and started sketching for the jury, just trying to lay it all out. The judge got out of his chair, came around so he could look at the whiteboard.
So what exactly should we be watching for? Just a bit more clarity?
Well, no. What we want to see is we want to see evidence that suggests that Google's Android actually violated the patent. So they're going to have to be very clear. They're going to have to lay out this is the language of the patents that applies, and here's how it's been violated. And that's what we have to look for in the trial.
Well, we'll see if we get a less confusing result this time around. Round 2 already started. Pat Walravens of JMP Securities, thanks so much for clarifying some of the confusion with this story. Thanks again. Coming up, Facebook formally kicked off its IPO roadshow today in New York with founder Mark Zuckerberg and other Facebook execs meeting with would-be investors. We talked to the first analyst who gave the stock a buy rating. And for all the latest headlines from the world of technology, be sure to check out Bloomberg's tech channel at Bloomberg.com/technology. Welcome back to Bloomberg West. I'm Emily Chang. A new survey finds mobile users are favoring apps over web browsers. Big time. The ComScore survey found that mobile users use apps 82% of the time, or 4 out of every 5 minutes. In addition, Google sites were far and away the top choice of mobile users. Google attracted 94 million unique visitors on its apps and browsers, or roughly 97% of the audience. Facebook came in second with 78 million unique hits and 80% reach. Yahoo sites were third with 66 million. And Mark Zuckerberg and company launched Facebook's pre-IPO roadshow in New York today. The tech mogul in his signature hoodie drawing crowds around the Sheraton Hotel as he went inside to meet with potential investors. Facebook is targeting $28 to $30 a share as the opening price, but my next guest says the stock is worth much more than that. Michael Pachter, managing director at Wedbush Securities, was the very first to issue a buy recommendation on Facebook stock with a target price of $44 a share. He joins me now from LA. So, Michael, obviously you're very optimistic about Facebook's potential here, but one of the things you think is a big risk to Facebook is actually Mark Zuckerberg himself and his mission to connect the world. How do you see that as a risk?
You know, I think actually you said something earlier that was pretty important. Mark in his signature hoodie, I mean, he's actually showing investors he doesn't care that much. He's going to be him, and he's going to do what he's always done. And I think that's a mark of immaturity. I mean, I think that he has to realize he's bringing investors in as a new constituency right now, and I think he's got to show them the respect that they deserve because he's asking them for their money. So what I'm concerned about is that he is trying to connect the entire world, and he's not going to get, minor considerations like growing revenues, not let that get in the way. And I think that the share price implies really rapid revenue growth. I'm not sure we're going to see that for the next couple of years.
In some way, Michael, could Mark Zuckerberg be Facebook's biggest asset as well as its biggest risk?
He most certainly is a genius, and he really has done something that no one else could do. I think he is well suited to be the chief product officer, the chief user experience officer, to manage the design of the user interface, to decide every feature that goes in. I'm not sure he's the right guy to run a corporation and have to answer to shareholders. And I think that if he does do that well, then this stock's going to work fantastically well. If he doesn't, then I think the stock is probably going to stall.
He did talk about the Instagram purchase, which was criticized in the media, some claiming Mark essentially went rogue there, did that all on his own without consulting the board. What do you think of that decision? Do you think it's going to contribute meaningfully to Facebook's bottom line?
You know, my understanding is that a large percentage of Instagram users were under 14. And just an anecdote, you know, when I went home, I ended up writing something on it, and I told my wife what I'd done that day. And I said, do you know Instagram? I wondered if she had used it. And she said, no, never heard of it. My kids, 12-year-old identical twins, both said, we use it. So, you know, I was real surprised at that. And I think that what Facebook was buying there was an opportunity. I think that they were looking at a large audience, I mean, tens of millions of sub-14-year-olds that will ultimately become Facebook users. And I think it was a threat because they could not have Instagram in the hands of somebody like Google Plus that would use it against them. So I actually understand that acquisition. I'm not sure they're going to do a lot of those types of acquisitions. I think they're going to avoid buying apps because they don't want to compete with the same people that they want to create content for their platform. They're certainly not going to buy Zynga, for example. And I think they'll only buy technology or large groups of customers that they don't currently have. So I don't have a problem with it. Maybe the price is a bit high, and maybe he should have consulted the board, but I don't think, in theory, that the acquisition was a bad one.
Well, he did say today he doesn't plan on making any more acquisitions of that size. You know, Michael, I've seen a lot of comparisons of Facebook to Google pre-IPO, and that Google was growing so much faster ahead of its IPO compared to how quickly Facebook is growing today. Are those comparisons fair, and is that at all concerning to you?
That doesn't concern me, but yeah, they're fair. I mean, you can compare Facebook to any great company that had rapid growth. I think the better comparison is probably to Apple. I mean, Apple had a genius running the company, and that genius didn't want to listen to anybody else and got forced out, came back a few years later, and he was older and wiser, and he ran it brilliantly. So Mark Zuckerberg might have the tools to run this company, but I'm not sure that he's actually worldly enough to pull it off. We'll see.
All right, Michael Pachter, the very first analyst to initiate a buy on Facebook. Mike, stick around. We'll be back with you after the break. Thanks. More of Bloomberg West. Next, we'll be talking about the future of Groupon. You are watching Bloomberg West, where we focus on technology and the future of business. I'm Emily Chang with your Bloomberg top headlines. Dish Network reports mixed results in the first quarter. The company added 104,000 subscribers, but profit fell 34% to $360 million. Dish has been dealing with higher costs to buy programming. It's also embroiled in a lawsuit with AMC Networks. Dish announced last week it is dropping all AMC channels because of low viewership. That, of course, includes Mad Men. ABC and Univision are teaming up to create a new 24-hour cable news channel. The channel will offer English-language news aimed at a Hispanic audience. It will combine news and production teams from both networks. The venture aims to have a website and some online content up this summer, with a TV launch coming next year. Groupon CEO Andrew Mason says he sees enormous opportunity ahead in a move to reassure nervous shareholders. In a new letter filed with the SEC, Mason writes Groupon is planning to expand its business into other areas, and he hopes to make the company a platform for local commerce. Groupon shares have lost half their value since the company's November IPO. And new earnings reports from the video game world. Electronic Arts saying profits soared in the fourth quarter to $400 million. That is up 165% from the previous quarter. Sales were up 26% thanks to a recent surge in digital revenue. But the news, not all good for EA. Shares are slumping in after hours after the company cut its forecast for this quarter. Meantime, Angry Birds creator Rovio Entertainment says its finances are strong enough to go public, and it's now preparing for an IPO. Rovio brought in more than $106 million in revenue last year. Our editor-at-large, Corey Johnson, has more from the newsroom. Corey, what does this all mean?
I don't know, but luckily we've still got Michael Pachter of Wedbush Securities, and he's been covering the game business for a long time and just got off the phone with Electronic Arts CEO John Riccitiello. Michael, what did he have to say?
He actually really wanted to know how they did, and you know, I've been an apologist for them for 5 years, so I'm not going to stop now. I actually think they're getting it right. I think that the reason the stock's down is that a quarter ago they said they'd grow double-digit top line, and today they said the top line was going to grow less than 3%, so about 115 million top line growth. People were looking for 400 million, and the reason for that
That's a big
is
difference.
they didn't. Yeah, they didn't name the game, so I'm putting 2 and 2 together, but I'm certain I'm right. The reason is that the team that worked on the Star Wars game, BioWare, those guys had to scramble to get that game out, and they had to scramble to keep it going, and they're the same people that work on Dragon Age, which is a pretty big game that customarily comes out in the March quarter. Looks like Dragon Age is going to slip. I don't think investors should say that Electronic Arts is worth less on a present value basis because one game slips a couple of months, but that's what we're seeing in the aftermarket. So I think the company made a mistake. They shouldn't have guided a double-digit top line and then changed their minds and guided to 2.5%.
And that's the Star Wars, the Old Republic game you're talking about there. So I was really struck when I looked at the numbers that the digital business is really growing fast. I mean, it's a year now. I know they did a big acquisition of PopCap, but in the last block you were talking about, hey, maybe Facebook overpaid for Instagram. Here these guys make this big acquisition, and Electronic Arts makes a big acquisition of PopCap. Digital revenues are suddenly 30% of revenues when a year ago they were 19% of revenues. That seems like exactly what you wanted of a big acquisition, no?
Yeah, and again, to be defensive of John Riccitiello, the CEO, he started this call saying we are transforming into a digital company, and they are. And you know, their revenue guidance on the digital line is going from 1.2 billion to about 1.7 billion. That's pretty impressive, you know, for a company that only does about 4.3 billion overall. It's a big, big deal.
Yeah. Well, now, what does that mean, though? What does it mean for the net profitability of the company? What does it mean for the gamer experience? What does it mean for the console business going forward?
Well, digital revenues tend to generate a contribution of about 50 or 60%. So when you see $1 of digital revenue growth, a lot of that drops down to the bottom line. As far as consumers, I mean, obviously there's some mobile games in there, social games, but they're also talking about the MMO, the Star Wars MMO. They're also talking about digital content that's add-on to packaged products. So if you play FIFA, then it's giving you updated player sets, different stadiums, different uniforms. That makes the packaged goods experience better.
Yeah, let's talk about FIFA. Isn't that the dominant franchise over there, that and Madden football? And the FIFA numbers, again, looked really strong in this quarter.
Yeah, we Americans like to think that FIFA and Madden football are kind of the same. FIFA is about 3 times as big as Madden football, so go figure. There are more soccer fans than U.S. football fans. Yeah, it's a big deal. It's their #1 franchise.
So going forward, do you think that, you know, there was concern that Zynga, with all this money they raised in their IPO, is going to be able to go out and do the acquisitions and just kind of raise the whole price of doing business in this world? It might not make economic sense on a short-term basis, but you got to pay to play, and that Electronic Arts would be hurt by this. Are we starting to see that kind of thing? Have the acquisitions slowed down?
Well, the PopCap one was a big one, obviously, at $1.35 billion for PopCap, but they have great assets. You know, Zynga's bought 2 big properties. You know, they bought the New Toy guys, which are Words with Friends, and they bought the OMG Pop guys, which is Draw Something. You know, spent a couple $100 million for the last one. I don't think EA is going to be bidding anymore. I think the loser here is somebody like Activision, because they're not even in this business. You know, EA at least has all these brands, and they're trying to extend these brands to social. Zynga's buying the brands if they can't invent them. So, you know, I think it's really going to come down to a two-horse race on social. And right now, Zynga is 3 laps ahead of EA. So, you know, it's not like EA's breathing down their neck in this race. Zynga is 4 or 5 times as big as EA in social.
Yeah, interesting. All right, Michael Pachter of Wedbush Securities. Really glad to have you for
Thanks,
2
Corey.
whole blocks. Not enough, but we'll take what we can get from you.
Thank
Emily?
you.
Thanks, Corey. And we do have some breaking news quickly to tell you about. We've just learned that Yahoo board is said to be meeting today to discuss Scott Thompson's future. Of course, in the past, other CEOs have not been able to survive Scandals like this, Dan Loeb, the activist shareholder, is calling for him to be terminated. So Yahoo's board certainly does have a lot to think about. As we've been discussing, we will continue to follow this story and bring you the very latest. Up next, Disney's superheroes could be helping save the movie studio from its John Carter flop, breaking records in the process. We'll tell you why this weekend's big box office pull for the Avengers could be a sign of good things to come. Welcome back. I'm Emily Chang. Billionaire Warren Buffett, who has mostly avoided investing in technology, says he has no interest in buying shares of Google or Apple. Responding to a question about the tech giants at Berkshire Hathaway's annual meeting over the weekend, Buffett said, quote, "I would not be at all surprised to see them be worth a lot more money 10 years from now, but I would not buy either one of them. I sure as hell wouldn't short them either." Buffett says he would have a hard time valuing the companies, adding that IBM is a much safer bet, at least for him. Buffett recently bought a stake in Big Blue. And we turn now to our partnership with Planet Forward, a program that brings experts and leaders together to create innovative projects in the areas of energy and sustainability. Today's energy innovator is Flex Energy. The company is finding ways to turn methane, a natural byproduct all around us, into a renewable energy source. Capturing it and using it is a big idea, but as Planet Forward's Frank Sesno explains, Flex Energy hopes to take the next step by going small.
Carbon dioxide represents 85% of greenhouse gases, but methane, ton for ton, is actually 25 times worse because it traps more heat and disperses more slowly. Now a California company says it can make good use of the kind of low-quality methane that is just blasted into the atmosphere now. Flex Energy uploaded their idea to Planet Forward.
We can take fuel that's 2.5% the strength of natural gas and turn it into electricity.
Flex says this low-quality methane is all around us. It comes from landfills as garbage decomposes, and most commonly from oil and gas production. Normally, the methane is burned. They call it flaring. At this oil field in California, though, Flex Energy converts it.
So when we're generating power from that methane, not only are we destroying a waste resource, but we're providing clean baseload energy. So we're kind of installing a pollution control device that pays for itself with a return on investment in clean baseload power.
That baseload power means the oil company generates all its own on-site electricity from methane to run its pumps and oil derricks. That, on top of not flaring the methane into the atmosphere, is a good thing. Now, methane turbine technology has existed before, but what's new is how small they can make it and how much power they can get from that low-quality gas.
You plug your laptop in, you plug your cell phone in at the end of the night, it's likely that the kilowatts that charge those devices were generated at a utility power plant, which is just a large gas turbine. This is a small, scaled-down version of turbo machinery that takes methane gas and generates power in a simple, discrete package.
Flex Energy says its innovation involves using what are called thermal oxidizers, which are typically used to destroy solvents and chemicals, now to create heat energy and power the turbine.
They're able to operate at lower temperatures, high enough to be able to produce electricity, but low enough so that they don't create oxides of nitrogen. And oxides of nitrogen, or NOx, is another greenhouse gas.
And as they said on Planet Forward, they believe it can have a big impact. Flex's next focus is to recycle methane produced in the fracking process that's led to the boom in natural gas production. Flex is betting the business that methane recovery can both make a profit and move the planet forward.
Frank Sesno, the creator of Planet Forward and also Director of Media and Public Affairs at George Washington University, is now with us from the university. So, Frank, what about the emissions from all of these operations? What actually happens to the methane?
Well, you know, this is what I love about this stuff, Emily, because, you know, when you start seeing, innovations like this that are sort of win-win situations, it encourages you that we really can invent our way out of some of the mess that we're in. So they're taking this methane. This is low-quality stuff that, as I said, has been, flared off or just leaked out into the atmosphere in the past. And while there are some emissions with this new system. Essentially, they're capping it, capturing it, and turning it right into power. So while there are emissions, there's nothing like there were when you're burning it out right out the end of the stick there, or just letting it leak from the landfill or wherever it's coming from into the atmosphere. This is a good news story if they can deliver.
And there aren't very many of those these days. Thanks so much,
Well,
Frank.
we'll take what we can get, right?
Remind us before you go how you submit ideas to Planet Forward.
Okay, well, if you think you're sitting on a great idea, and isn't everybody, think something like that, go to planetforward.org. You'll see in the upper right, submit your idea. Click on that. It'll walk you through it. As far as we're concerned, you can produce a piece like this with all these cuts, talk right into your smartphone, and then feed that in. And then the good ones that come in, we post them online. And the really good ones, Emily, we bring to you every Monday. How's that?
Great to hear. Frank Sesno of Planet Forward, thanks so much for joining us. For more environmental and sustainability news, make sure to check out Bloomberg.com/sustainability. Now, Marvel's The Avengers set a new box office record this weekend with ticket sales of more than $207 million, proving Disney was right to bet on Marvel and making up for some of the lost ground with that big box office flop, John Carter. Bloomberg's Gigi Stone is in New York with all the details on why studio execs hope this is just the beginning. Of course they hope so.
Yeah, it's pretty crazy, Emily. In just its first weekend, the Avengers managed to recoup the big dollars spent on making the film. But execs in Tinseltown are really hoping this is the start of the trend, simply because they spent an unprecedented amount on their latest movies. Now, this season is actually the film industry's most expensive ever. In total, the studio spent more than $2.7 billion to make this summer's big movies. That's an increase of 29% from just 2 years ago. And 5 of the top titles cost more than $200 million each. That was a once unthinkable ceiling not too long ago. Besides the Avengers, those include Warner Brothers' next Batman movie, The Dark Knight Rises. There's Sony Pictures' Men in Black 3, Sony's latest Spider-Man reboot, and Universal Pictures' Battleship. There's so lots of superheroes, lots of aliens.
So, Gigi, why are studios spending so much more on movies this year and essentially taking bigger and bigger risks?
Yeah, it's an interesting question. The reason is the studios are spending so much is because they're facing a lot of pressure to produce these over-the-top special effects. And that's driven by the fact that Hollywood's revenue growth is coming from international box office receipts, especially given the ongoing decline in DVD revenue. So studios really need to predict what foreign audiences want to see. And let's face it, the safest bet is fantastic action effects. They don't need any translation. And the numbers are staggering. International ticket sales grew 35% over the past few years. Compared to domestic grosses, they were up only 6%, Emily.
And, these risks don't always pay off. Obviously, Disney has a lot to make up for with John Carter, so Disney's got a lot riding on the Avengers, right?
Yeah, Disney really needs this hit. It comes on the heels of the John Carter bomb, which, as you know, is responsible for a $200 million loss of the studio. It's been producing fewer films this season and really counting on them to boost profits. It did this record-breaking marketing push for Avengers, $100 million. And this big opening weekend is, insiders tell me, is sure to feed speculation. Marvel chief Kevin Feige will possibly replace the recently ousted studio chief you've heard so much about, Rich Ross. We'll find out a lot more when Disney releases its earnings tomorrow. It's going to be a big day for them.
And right, we will be covering those earnings, of course. Gigi Stone in New York, thanks so much. Later this week, we will have an exclusive interview with Disney CEO Bob Iger. That will be all day on Friday on Bloomberg Television. Now, there have been some concerns that Facebook's revenue growth is slowing. So how can the social networking site change course? Our next guest has some ideas. Turning back now to one of our biggest stories of the year, Facebook. As Mark Zuckerberg hit the road today to convince investors to buy into his company, questions remain about how Facebook can keep growing with membership nearing saturation. To help us answer this question, we are joined by Clara Shih, co-founder and CEO of Hearsay Social, a company that helps businesses engage with their customers through social media. She is also the author of The Facebook Era, Tapping Online Social Networks to Market. Clara, welcome back to the show. Great to see you. So we were talking earlier about concerns about Facebook's revenue growth slowdown. 85% of Facebook's revenue comes from advertising. How does Facebook diversify that?
I think we're already seeing Facebook diversify into new ad formats, such as sponsored stories. And it's just the beginning in terms of their monetization with mobile, with internationalization, and with tapping into traditional digital monetization formats, such as search and commerce.
So sponsored stories, tell us about those and how significant they're actually going to be to the bottom line. We haven't seen the potential of those yet.
Well, essentially, sponsored stories are taking activities that are already taking place on a Facebook business page, actions that existing users are taking, and broadcasting that to a greater audience. I think we're just seeing the tip of the iceberg there.
Facebook also, as you said, hasn't really started with mobile yet. How do we know they're going to reach full potential?
Well, I think if you just look at across Facebook's 901 million users, half of them are using the Facebook mobile app, and so I think Facebook is primely positioned to monetize on mobile.
We were talking about comparisons to Google earlier and whether or not that was fair. Where does Google stand in all of this? What does Google have to lose?
Well, I think if you look at some of the best executives and employees that were at Google in the early days, a lot of them are now at Facebook, and they're bringing that innovation and that experience to Facebook. And the thing with technology is that there's a new tech darling that emerges about once a decade, and certainly this is Facebook's hour.
So, in talking about the winners and losers, would you consider Google a loser?
I think the verdict is still, the jury is still out there, but certainly there's a formidable opponent that they have in Facebook.
So who are the losers?
It's a good question. I think certainly the traditional offline advertisers are going to continue to erode market share to online advertisers. A lot of that is going to be in social media. Also, the traditional software vendors, I think SAP, Oracle, they've struggled to truly embrace social media.
What about the winners?
Well, the winners, certainly on the consumer application development side, we see great companies like Pinterest and Instagram taking advantage of Facebook as a means of distribution. And then on the business side, platforms like Hearsay Social that are making it easier for businesses to get on Facebook.
That is, of course, your company. You recently replaced Sheryl Sandberg on the board of Starbucks. Do you have any idea why she left?
It's hard for me to say, but what I will say is that Starbucks is making great strides on social media and digital overall.
So now that you are on the board, what sort of recommendations are you giving to Starbucks about how to use Facebook, given its expanding reach, obviously online and on mobile?
Well, what I tell Starbucks and what I tell all of Hearsay Social's customers is really not to view social media as a one-off pilot. I think that's what we saw the last 12 to 18 months, but actually to take social media as an opportunity to completely transform the business and really listen to the customer.
Okay, well, Clara Shih, author of The Facebook Era. We have a lot to watch over the next couple of weeks with Facebook going public. Really appreciate you stopping by to share your thoughts. Up next, stick around for our B West Bite, one number that reveals a whole lot. Time now for the B West Bite, where we focus on one number that tells a whole lot. Corey, what do you got today?
$1.17.
$1.17.
And that's the average revenue per user for Facebook last quarter. That's down 7% from the same quarter last year. So for the first time ever, they're seeing declines in how much money they make out of their customers.
Well, and this is what we've been talking about throughout the show. And what's interesting is a lot of the new users are going to be coming from emerging markets, and those users are going to be more difficult
to monetize. Right, or they'll be mobile users, right? They'll be mobile users. They'll be in foreign countries. They'll be in third world countries where people don't have as much money in some cases. So, if they ever do get into China, that could be a lower revenue user. Mm-hmm. So they've been able to add so many users. You've seen revenues go up, but every new user they're adding, all of a sudden, is worth less.
And Michael Pachter, earlier was talking about how Mark Zuckerberg's mission to connect the world, that is his mission above all else, could actually slow Facebook down and take a longer, it'll take longer for Facebook to sort of reach the potential some investors are hoping for.
Profit's not his goal.
All right. Thanks, Corey. Thanks so much for joining us on this edition of Bloomberg West. We'll see you back here tomorrow.